So again, welcome to another Centaura webinar. Today, we're going to be talking about curation in DeFi, specifically with lending protocols. Uh, a couple webinars ago, I talked about vaults and just like the general setup of how vaults are, how the different structures of vaults that exist in the DeFi space are. And probably one of the most well-known vault structures, let's call it, is curated vaults on lending protocols. And so today we're going to dive into uh, what um, what it entails to do curation on a protocol, and some of the best practices, or the practices Centaura uses for their curation in different protocols, and some of the things that for users or just in general items to track to make sure that you aren't entering a curated vault that maybe is more risk than you perceive it to be. Anyways, we'll get started. Uh, with how we'll go through this webinar today, we'll give you some updates as always. Do just kind of a quick overview of what curation is, talk about guardrails and risk. I think that's going to be the most interesting part, and then some of the strategies for curation, how to like implement it, and then an outlook of where Centaura sees curation going in the next couple of years. So first off, as always, Centaura updates. We've done a lot since our last webinar. We launched a vault with Lombard, so you can deposit your LBTC into the Lombard vault, and then Centaura is running the strategies behind that vault. So coming back again to the other vault talk we had, this is a vault that is running multiple strategies for a specific asset for a protocol. And so there's several complex strategies that we run on this to allow for yield to come back to the deposited asset, your underlying LBTC. So go on over to the Lombard page if you want to check that out and see if it's interesting to you. Also, this is probably the most novel thing that we have recently launched is Centaura tokenized equity yield. So this is in partnership with Chainlink, Euler, and Ondo, uh, where you can use your tokenized equities like Tesla, SPY, QQQ, and you can borrow stablecoins from this. And specifically from the Centaura side, what we offer is being able to then, in all one structured product, is you take your equity assets, you borrow the stables, and then deploy this into another strategy to earn yields or returns on the tokenized equity that you're holding. So definitely feel free to drop us a line if this is something that's interesting to you, and if you're holding Ondo assets of this sort, check out the Euler page or check out our page to get more information on that. And then finally, some minor updates on our risk radar. We've added some new indicators in the past couple months. So we've rolled out new indicators that monitor ABSs and slash risks for all LRTs that we have on our dashboard. So EtherFi, Kelp, and many more, where you can see how they're allocated to different ABSs. So quick reminder, this is the different projects that are using the security from the staked ETH in EigenLayer or EigenCloud as it's called now. And so you can see the distribution. Here's a chart on the right of the distribution of EtherFi, the wrapped ETH, across the different ABSs. And then also you can check things like if there's any actual slash risk that EtherFi or these other LRTs are taking on through the indicators that we provide. So they're pretty interesting, worth taking a look. And then we've added a couple more indicators to our Euler dashboard, mainly tracking the collateral distribution of any of the vaults, and then also tracking liquidations. So this is really helpful information if you're trying to understand a market and how it's interacting with different market volatilities that you see. So go over to our risk radar to check those out. Now, moving into the meat of the webinar, curation overview. So just giving a quick highlight of what curation is for anybody who isn't quite sure what it means, since some of these, the nomenclature can sometimes be a bit fuzzy in crypto. So to start off, like, why does it exist? So curation is a way for, especially on modular protocols, for a user to deposit their assets, often stablecoins, into a vault that then is allocated to different markets where other users can come in and borrow those. And so in the modular structure of a lot of the protocols where you see curation existing is the big appeal for curation is that it allows for isolating risks, which is something that is really important to institutions. So if you want to go into a certain market and deploy your assets, you want to only have exposure to a certain amount of different collaterals. You can really pick and choose and customize a bespoke setup for that institution. And you can even set up in a way where you have one market where maybe multiple institutions deposit into it in a certain way, and then have it split out so they're only taking on certain risks from different collaterals. I think the biggest institutional side item that we have seen, especially in curation, is from Coinbase having this direct integration with Morpho. So users are able to take their Bitcoin on Coinbase and borrow stables. And so this is a very isolated market. It's just that one market, Bitcoin or CBBTC, the Coinbase version of Bitcoin, and USDC. And so this allows users to tap into maybe cheaper liquidity on chain than it would be for doing loans at another institution. And plus, it allows them to keep their Bitcoin. So these are some of the reasons that curation exists and has been seeing a lot of growth. I already tapped on the isolated market structures, allowing for these kind of bespoke designs based on the main users of a different vault. And then a piece that is quite nice and is even more like DeFi oriented is that it allows for very isolated exposure to different types of more exotic collateral. So really the thing that we would see growing in the last year, and I think will grow a lot more, is different types of RWAs, so real world assets. While they all get lumped into this one category, each RWA has a very different structure. And so they can't really be considered all the same. And so this sort of modular design in a lending market allows for you to really customize how much exposure and what are the parameters that you have within that market for that specific asset. So this is where we've seen a lot of growth in the last months on curation. And then for better or for worse, it allows to bypass to some extent governance bottlenecks. So curators are managing their curation cluster, and they are the ones that are able to add or remove different collaterals. And so the protocol doesn't have to come forward and make proposals and have a vote to have each different collateral onboarded, because it's not exposing the entire protocol to that one collateral. Instead, it is actually just that one curator that's taking on that exposure. And so any other curator is not affected by that specific collateral addition, allowing for faster integrations and maybe more exotic collaterals, as I said, compared to if you were in some sort of, omni lending vault where all assets are exposed to each other. While this market, this chart here, it's hard to see, but we can see that modular lending is slowly but surely gaining traction. This is just a snapshot over about the last year. It's steadily growing compared to non-curated lending, like these omnivault structures that I was explaining. So this chart, while it looks tame, I imagine to see this start to really pick up in terms of the red part of the chart, taking a larger and larger piece of the pie. Um, so it becomes a design where it's very easy to scale, and the base protocol doesn't necessarily have to do all of the business development or push all of these things. These different curators kind of act as their own agents to make growth happen, which can, eventually feed into the base protocol in terms of revenue sharing or something like that. So it is a design that is very nice for the protocol and also for the curators who are wanting to really focus on maybe niche assets or a specific pairing of assets at a more competitive rate than the rest of the market, allowing for more diversity. Kind of coming back to what was in the last slide, this is a very high level, basic kind of look at how a curated market on a modular lending protocol looks like. So you have this two-layer architecture. There's the base layer, which is the protocol itself, and then that base layer is usually holding all of the markets and the different pairings, etc. And then you have the vault layer that sits on top of this. And so what happens is a user deposits into the vault layer, which is managed by the curator, and then the curator deploys into the base layer, where they're allocating to the different markets based on how much exposure or what their strategy is. And then all of the yields from all of those different markets get fed back up to the vault, which then eventually goes to the depositor. So for a depositor, it can be easy or appear easy because you just have your asset, you want to earn on that asset, you deposit it into the vault, and then the curator is managing all the complexities and then either trying to give you the best risk adjusted yield, or they're just maxing the yield if you're a bit more degenerate. And so you can choose the curator based on kind of your risk profile. What are curators actually doing? So I've already touched on it a little bit, but the biggest items that they do is they choose the collaterals and markets that they want to get exposure to. I think this is the biggest item of what a curator does. And then depending on the protocols, they have different accessibility into some of these other parameters in terms of configuring oracles, setting LTVs or liquidation parameters, and then setting different caps or other operational controls. So, maybe you only want to have a max amount of one collateral exposure, so you can set a cap on a certain market or how much your vault is exposed to that. So you have a fixed risk on how much exposure you have to given assets. And then again, yeah, managing and allocating these strategies. So as an example, this is a chart from our risk radar on our allocations in our Morpho market for PyUSD. So as you can see, it evolves over time, how much exposure there is to different collaterals. This is partly based on demand and then partly based on us changing cap rates. So for example, this large jump up you see in SUSDE it can be when we increase the cap on how much we're exposed to that collateral. Deploying into a curator or a curated vault changes the trust surface that a user has. So it's still non-custodial, as you see with a lot of the more traditional um, omnivault style or universal lending protocols that only the user can deploy and withdraw their capital. The curator doesn't have the ability to withdraw another user's capital. Um, but the risk decisions get pushed off from the user, deciding if all the collaterals that they're exposed to are ones that they're comfortable with, to the curator who's making these choices. So you do need to do some due diligence as a user on the curator to decide if their decisions and how they execute is in line with what you think as appropriate for your risk profile. And um, how these controls, some of these controls usually look for a protocol is that there's the owner of the vault. So that's usually the curator, and then there's like a curator um, role that is maybe doing a lot of the cap increases or decreases. They can also be the one choosing the collaterals, but sometimes you can separate those out where the actual allocations between the different markets you're exposed to is done by a separate role. And so like these two roles have different powers or ability to make different decisions. And so depending on the structure of the curating entity, they might separate these out or they might have them all together. And then additionally, you can have some sort of like sentinel or guardian role. So this is even a third party outside of the curator. So for example, like Hypernative, you could have them as a sentinel or a guardian where they can watch the markets. And if any exploit or any issue happens, they have the ability just to pause the markets. They don't have allocation powers or add collateral change caps powers, but they can pause the markets to make sure assets aren't lost. All of these things are usually done with time locks. So since the curator has the directive to make these changes, most protocols have time locks in place. So this gives at least a couple days ahead notice where anyone deploying into these markets, if they see a change, they have the ability to withdraw before that takes effect. And then kind of coming back to the Guardian and Sentinel setup, there's usually some emergency breaks, which is a pausing function that allows users to or allows the curator to manage any sort of incident that happens in the protocol if it does. Now coming to what I think is the most interesting part is the guardrails and risks. So like what are curators actually doing behind the scenes? This is each curator probably has their own secret sauce, but this is at least allowing you to get an idea of what's happening for each of these curators as they manage the markets that they're involved with. So the four pillars I would say are the parameters. So the flexibility that a curator has depends on the protocol, but the loan to value, the liquidation loan to value, because sometimes these are separated. So you have a loan to value max, and then sometimes you have a liquidation value that's above that. So there's a bit of a buffer. And then other liquidation parameters like bonuses and stuff. This can be adjusted sometimes in the different curated markets. Oracles. So most of the time when a curator sets up a market, they're also establishing the oracle. So this is something that can cause issues. It has in the past that there's been misconfigured oracles or a poorly chosen oracle led to some sort of price manipulations that allowed for incidents to happen in markets. So this is something that you want to make sure that a curator is able to do that correctly. And then like on the day-to-day managing, caps and liquidity controls. So either caps on supply or borrow to given markets, and then also liquidity controls, maybe how fast money can flow to these different markets. These are items that a curator is managing. Excuse me. And then, as I said, I think most importantly is collateral inclusion. So what collaterals are the curators choosing in the market. So as an example here, I'm showing Euler has this really nice mapping of how different clusters that are curated by different curators are set up. And this is our PyUSD cluster from Centaura. And looking at just this SUSDE connection here. And so you can see here, you can see the Chainlink oracle that is set there, the borrowing LTV and the liquidation LTVs. So these are things that Centaura is inputting on our side when we're creating the different vaults that we use in our Euler curated clusters. So diving into the parameter setting, LTV and LLTV, I think these are pretty straightforward, but for a curator, their biggest item is that they're competing with other curators and the market in general. So they need to make the best risk-adjusted decisions as they can. So LTV, LLTV, of course, if you can borrow more for whatever collateral you put in, that means your capital is more efficient. But if the price stability or the collateral is poor, this can lead to liquidations that might incur bad debt. So this is one of the things that is really important for choices on the initial parameters. Some markets, it's somewhat fixed that you can only choose specific LTVs in the market. And so this, in the end, doesn't tie the hands, but it reduces the choice or the how the curators can manage these things, which can be good and bad depending on the curator. Supply and borrow caps. Yeah, this is, as I said, just you want to make sure that your exposure limits are correct. You want to make sure that you're not exposed to so much collateral that if a large liquidation happens, there isn't actually enough liquidity in the market to execute the liquidation, because then that would mean bad debt could accrue. And then interest rate model tuning. So this happens in different ways on different markets, but basically what sort of target utilization of the market you want to have, how much is being borrowed out essentially, and then what sort of like parameters you're putting in place if there's stressed behavior. So as an example, in Euler, you can choose the IRM and you can update it whenever you want. So you have a lot of flexibility on that. On Morpho, basically everybody uses the dynamic IRM that Morpho created, which changes based on the utilization. So you can still do some tuning, but it's a little more nuanced because it's just based on how much utilization in the market will change what the interest rates are for the market. So it's not equal across all protocols how you do some of these parameter settings. And then liquidation incentives, like how much based on your LTV or your LLTV will kind of change how the bonuses are. So if you're thinking that there's going to be an asset that is going to be really hard to liquidate, you might want to make it so it has a juicier bonus, which allows for liquidators to come in easier. And something that's really has deep liquidity, even just getting 1% bonus for a liquidation, which a bonus means that the liquidator essentially gets a piece of the collateral that they get to keep as their profit. And so these are important to keep in mind and set when possible based on whatever the collateral is and how much liquidity there is in the market. Oracle risk, yeah, this one can be really tricky, but yeah, any sort of outages or stale feeds or any sort of like exchange rate manipulation vectors can cause instant bad debt almost on a market. So these are really important to set, and they can be, for example, excuse me, they can be immutable in some markets. So for example, on Morpho, when you set up a market, you set the oracle, and then that market is set like that. So if you needed to change your oracle, you'd have to change the market and kind of scale out of the market that you already implemented. So this choice is really important at the beginning. And then, any sort of fallbacks or deviation checks. This isn't necessarily on the market level, but this is something that the curator would want to be doing in the background to make sure that the oracle is still performing as you assumed it to be when you initially launched the market. Liquidity risk. I think this is probably one of the more important ones. So you have to find this balance of having high utilization means higher yields for the suppliers, but you don't want to have max utilization of 100%, which means that people can't exit if they want to withdraw their capital. So this is a constant, cat and mouse game of trying to find the sweet spot for the depositors and for the borrower side, because they want to borrow that capital, but the depositors also want to be able to exit. And so an example here is of a market where over the course of 3 months had 30% available liquidity, and it dropped down to under 5%. So this is a really large drop. And so this means that users here might not be able to withdraw depending on the size of their deployment in the market at this trough here that you see. And as a curator, you're trying to constantly manage that to make sure people can exit easily, because if they can't exit, then you start to get panic, and this can lead to run on the bank situations that don't help out anyone. And then collateral risk, as I said. So the collateral risk is a tricky one. There's so many new collaterals coming on, especially from RWAs, and it's very hard to get full visibility on some of these, or they might be so complexly engineered or with mechanics that are very complicated that you really have to pay attention to how they are in the market, how they act in the market. So, one thing can be, I think, stream finance, if anybody's familiar with this, is one of the best examples of rehypothecation or recursive leverage, where essentially people were depositing USDC into this vault that Stream was managing. It minted a new stablecoin called XUSD that could be used as collateral in a market and then borrowed again to loop, because the XUSD was earning yield. And what was happening was that Stream was just doing that circular loop. So all the deposited assets were coming into the vault, the USDC side of the vault, and then it was leveraging on the other side where people were borrowing and looping. And while this isn't necessarily a flaw in itself, this means that if there are any issues, the cascading effect of liquidations as they unwind all of this can become very, very large. And this is where you can lead to a situation where people get scared. They want to, pull out their money immediately. You start to see depegs, and in these events, that's when bad debt can happen. And then off-chain dependencies. For the RWAs, this is really important. So custody, legal governance, these things can break and cause issues, as well as off-chain dependencies from the RWAs, like any sort of lag in data off-chain, or stale data, or delayed impairments, which this chart here shows a good example of Fasanara's MF1 product, where essentially basically the backing of this token is private private lending off chain, and they had a write down on a defaulted loan, and so all of a sudden there's just this massive drop in the pricing here, and then it continues back up. So if a curator has set up their market too aggressively, this massive drop could cause liquidations. But the delayed impairment that I'm referring to is that if you are having access or being able to check the reports from Fasanara, you would know that there were these upcoming write downs that were going to happen. And so it creates this incomplete information for everybody in the market. And if you aren't able to pull that and monitor it on chain regularly as a user, you wouldn't know until potentially it was too late. And so how do you set up a checklist to make sure that the collateral that you choose is good? So I think obviously audit history and admin privileges. So what can the admin do? Mint the tokens however they want, or is there only assets coming in, create minted new tokens? Audit history, of course, you don't want to have a collateral that's in an unaudited protocol. Then DEX liquidity depth or the accessibility for redemptions. This is really important for the liquidator side. You know, a liquidator won't liquidate if it's not profitable for them. And so there's really two methods to do that. Either they liquidate through the market or they liquidate the position, they take the collateral and they redeem it back to the underlying so they can liquidate easier. So having these really accessible and being able to uh, maintain stability under duress is really important for collateral. Um, Oracle availability. So this is kind of a given that you need to have reliable oracles and you need to be choosing the right oracles to make sure that there isn't a lot of volatility in the market that maybe causes liquidations that are kind of superfluous that don't actually impact the underlying asset. And then any sort of volatility or correlation characteristics. So again, with the rehypothecation, this is one of the issues on terms of correlation, but then also with like leverage restaking, leverage staking, the correlation or volatility between these assets. If you're borrowing ETH and you're supplying an LRT, they're probably going to be highly correlated, and so they'll move with the market. And so you just want to make sure that the correlations you assume that this would have do indeed have exist through backtesting and other methods. And then if there are any off-chain dependencies, you identify them and you monitor them constantly or as much as you can. So as an example, in terms of like liquidity depth, on our internal dashboards that we use for curation, we check, you know, daily slippage or price impact of different asset pairings and see how these evolve over time by day, by hour, to see where the market is trending, if there are any sort of regime changes within the structure of the asset or in the market in general. RWAs, of course, are quite different. So a lot of it depends on off-chain components that are much harder to address. And so, you know, you have to check any sort of legal enforceability. If this RWA is backed by home loans, how well can it be liquidated? If it's backed by some sort of tokenized contract for an off-chain asset, is that tokenized contract enforceable? So if they go to claim the assets to liquidate them, will they actually be able to? Then, you know, are there custodians? Are there any qualified custodians that are holding some of the assets to make sure that they're managed correctly? And the issuer is the issuer reliably minting and burning in the kind of service agreements that they've proposed to the users? On liquidations, there's always an issue with RWAs because they're often slower. Redemptions, like as I said up here, the accessibility to redemptions is usually more restricted because it's often a KYC'd or whitelisted redemption list. So this limits the avenues that a liquidator can use to access a liquidation. So this is something to keep in mind. And then for things like equities, you don't always have 24/7 price feeds like you do in crypto. This is an example of one of the Ondo stocks is you see these flat lines. This is where the market is closed over the weekends. So you need to make sure that you're taking that into consideration with how you set up your market structure to be able to handle if when the bell opens on Monday and there's a drop like you see here, that the market that you're curating is able to handle it correctly and not have any sort of superfluous liquidations, or there's enough liquidating power to perform the accurate liquidations that are needed. And then you always have to assess what the backing is what sort of off-chain liquidity there is, and the underlying asset performance. So are the things they say they have backing the token off-chain existing? Are they liquid, or can they be liquid? And how is that? How is the performance of those assets doing? Is the market, housing market going up, going down, etc.? Uh, Coming back again on this like monitoring of these hybrid, I mean, almost all RWAs are some sort of hybrid on-chain, off-chain asset. There are other items like Athena, USDE. We can kind of consider it to be on-chain, off-chain since they are running different procedures off-chain, but they're not considered necessarily RWAs. These all kind of fit into the same category in terms of things you need to assess. On-chain data is real time. This one is really easy to track. That's one of the benefits of the blockchain. Off-chain data is often slower, and there can be certain information gaps that, if they persist, can produce latent alerts, somewhat like the Fasanara instance that I was talking about. And so you need to be able to both monitor on-chain and off-chain. So utilization flows, Oracle deviations on-chain, off-chain, issuer health. So are they minting and redeeming as you expect them to be? And any sort of relevant domain signals, such as market pricing or any sort of crunch and liquidity in the market environment, the housing market environment. As an example, you can see here, this is Maple loans. And so these are institutional loans that are off chain. And for us, we use Syrup USDC and USDT in our products. And we have a really good connection point to make sure that we can monitor the collateral levels of these loans to see if there's any sort of issues. And we check these on a regular basis to make sure we don't see any sort of health factors that are worrying, or we see replenishment of collateral whenever collateral levels drop. Now, moving on to the outlook, this will be fairly quick. Strategy design is really, for any curator, you select your assets, you set your parameters, you monitor, and then based off of kind of this recursive feedback, you rebalance or you reposition your parameters as the market adjusts. Regime changes happen, and you need to be able to adjust to those different changes in the market. Emergency responses or incidences can be like growing informational. So any sort of have an emergency response in place. Any incident that occurs, you produce a postmortem and you use that for improvements. And then make these iterations a part of the product and why it's strong rather than not just a one-off. So make it anti-fragile if you can. Stress testing and automation is always a benefit. So as the market runs 24/7, automation is crucial to make sure that you can move money when it needs to or withdraw things when you have to. And so back testing through different market environments, scenario testing on certain like black swan events that you expect, or any sort of adversarial testing. And then, like balance sheet tests to see what would happen if a whole unwind happened on something that was rehypothecated. And then making sure you can automate as much as possible is always a benefit. How do we see curation moving forward? One of the things that we see, curation is a very competitive market, and a lot of these curated markets are getting direct connections into institutions or centralized exchanges. And so what is going to probably happen and what should happen in the coming years is that for any sort of neobanks or even traditional banks that are wanting to come into the space, partnering their maybe types of yield products that they have on their chain with this curation side is going to be very beneficial for them. And it's going to help them draw in liquidity and also diversify their risks from other strategies that they might have. So banks, we think, will come. They'll be coming in some shape or form, but they'll be coming in and they'll be running their own curation strategies as well. And then we're already starting to see this, but agent curated markets. So some sort of AI agent that is doing all of the procedures on its own. This is surely going to continue growing. It's something that most of this can be automated. And if you can set up enough agents to run this on their own, you can probably have a fully autonomous curated vault. And I think it's always good in crypto to try and push for some sort of professional standards with disclosures, really trying to state how risky you think the products are that you're going into, so the users have full knowledge, and then having some sort of universal risk labels. This can always be very helpful. And then this it sounds a bit weird, but convergence on vaults and curation. All of the different vaults that I talked about in the previous webinar and curation, like these things are just kind of slowly going to become one. We're already seeing it with Morpho V2. They're going to have vaults that are curated that can do a lot of the capabilities that you see in other types of DeFi vaults that you see out there. So this is already starting to occur. Please join us for our next webinar on DeFi intelligence, how to use AI for identifying risks and finding opportunities. This is March 25th. So thank you for joining, and hope you guys enjoyed it. And yeah, I'll stick around for any questions. Just feel free to send them in the Q&A box, and I'll try and answer as many as possible.